Hi, and in this video we will do the income statement using the absorption costing way. Alright, so as we know, I explained it in the previous video, when we focus on absorption costing, so another word for absorption costing is full costing. Okay, so when we say full costing, it means we are going to take into account both fixed cost and variable cost when it comes to finding out what our cost of production is when we're dealing with the cost of sales. All right, so in this case it's cost of productions because we are manufacturing the goods ourselves. So usually in questions you will have variable manufacturing overheads, or you could have fixed manufacturing overhead. So remember, when we're dealing with absorption costing, when we're doing our cost of productions, we have to include both variable and fixed overheads, only those that relate to the manufacturing part. Okay, so for example, this is non-manufacturing, so it's not going to be included when we are calculating our cost of productions. Okay, so first step we have to do is we need to find out exactly what is our absorption cost, and you can see that in the previous video as well, but we will go through it again. So let's do the question first. XYZ Limited manufactures and sells a single product. The following cost data relates to the company for the year ending 31st of December 2024. So we have direct materials $10, direct labor $6, variable manufacturing overheads $4. Then we have fixed production overheads is $50,000. So you will usually just get a fixed amount. It's very rare that you're going to get a per unit amount for fixed overheads because it's not related to a single item like direct materials, direct labor, but fixed is like overall. It does not change. So let's say if I'm producing 10 jeans, I will always have to pay, let's say, 10,000 for a particular process, no matter how many jeans I'm going to be producing. Okay, then we have selling and admin expenses, which is $3 for variable, and fixed is 20,000. Then inventory and sales data, we have opening inventory of 800 units. We produced 5,000 units. We sold 4.5 thousand units. We need to calculate closing inventory, so take note of that. And our selling price per unit is $40. And the required of us here says that we have to prepare the statement of profit and loss using absorption costing. Alright, so the first thing that we can do is find our absorption cost. Okay, let us do that right below here. So let us calculate our absorption cost. This is our per unit. Okay, so this will make it way easier for us, and you will see. So this means we have to add our direct materials, your direct labor, and remember your fixed overheads and your variable manufacturing overheads divided by your units produced. Okay, and then we can just go above and we see, okay, our direct material is already in units, so we can just keep it like that. So direct material is $10, direct labor is 6, so we have 10 plus 6, plus we need to get our fixed. So fixed overhead, we need to get it in units, so it's like fixed, so it's 50,000. So we just have to say 50,000, okay, divided by our units produced. And let's see, what is our units produced? Here it says units produced is 5,000. So 50,000 divided by our 5,000. And then we add our variable manufacturing overheads, and it's per unit, which is $4. Okay, so this is the only one that we're going to divide by the units produced because we want to get per unit for all of them, and they are all already per unit, so no need to divide by the units produced. So we say, okay, let's deal with the middle bracket first. So we have 10 plus 6, so our 50,000 divided by our 5,000 gives us 10 plus 4, and our total absorption cost is your 10 plus 6 plus 10 plus 4, and this is $30. So our absorption cost is $30. All right, that is done. And another thing is we need to calculate our closing inventory before we go ahead with our statement of profit and loss. So what is our closing inventory for this year? So remember, it's December, end of December 2024. So we need to calculate our closing inventory, which is our opening inventory. Okay, I'll just abbreviate that. Opening inventory, we add the units that we produced now, okay, and then we deduct our units sold. Then we will get our closing inventory. So our opening inventory in units, okay, is 800 units, okay, and then we are told that we produced 5,000 units right there, okay. So then we have to add our 5,000 units, and now we have to deduct the units that we sold, because now closing inventory, we want to find out how much inventory do we have at the end of the year. So we sold 4,500 units. So at the beginning of the year we started with 800 and we produced 5,000 units, so we had 5,800 units. Then we sold off 4,500 units, so that will be 5,800 minus 4,500, so we are left with 1,300 units. So these are the steps that you can always take when they ask you. You can start off always by calculating your absorption cost and include your fixed cost, because normally you have your variable costing, which does not include your fixed cost, but in this absorption cost you're absorbing all the cost, including a fixed cost. Then you go ahead and calculate your closing inventory if they didn't give that to you. So our closing inventory is in units. Please keep that in mind. So now we can start off with our income statement. Okay, so to start off we can say our sales. So here we can have, I'll have two columns right here. So we can start off with our sales. Okay, so what are our sales? So what have we sold? So it tells us we sold 4,500 units. So we can say, okay, 4,500 units. How much was it to sell? The selling price it gives us here is $40. Okay, so the units sold times your selling price per unit. So 4,500 times 40, how much does that give us? That gives us 180,000, and I put that right here in our last column. Good. So sales less my cost of sales. And you know, in your normal statement you always have sales less cost of sales, then you have your opening inventory. Now this is where I'll give you different methods on doing it. So you can either say opening inventory, then you have your add your cost of production, but in this case you can do it like, you can add, you have your direct materials. So this is cost of production cost. You can add your direct materials, direct labor. You add your variable production overheads or manufacturing overheads, and your fixed production overhead. So you know what that means, I'm just abbreviating, okay? Then we can get our gross profit. All right, you can do it that way. So our direct materials is at $10. Okay, so we will just say $10 times your units produced here, which is 5,000. So 10 times 5,000, if you put that in your calculator, it should give you 50,000. Direct labor is at 6. So 6 times 5,000 gives me 30,000. Variable production overheads is $4. So $4 times 5,000 will give me 20,000. And then my fixed production overheads, it's already given me the amount, so I can just write it down as the 50,000. That does not look like a 5. 50,000. Alright, so if I add this amount, I'll get my production cost. However, since then the other way you can do it is, instead of writing everything down, we can just take our absorption cost, which is $30, right? So we can just say, this is just an example, so we can say our absorption cost, which is $30 times our units produced, which is 5,000. And if you add them all, and if you add up, let's say if you add all of this up, you will get the same as that. So I say 50,000 plus 30,000 plus 20,000 plus 50,000, it's 150. Okay, that's what I get, $150. And then if I use the just take my absorption cost per unit multiplied by how many units I produce, so 30 times 5,000, I also get 150,000. So I'm just showing you the different ways on how to do it, but this is the easiest way. It's just to get your absorption cost per unit, and then you just multiply it by how many units you have produced. But you can also do it this way. So now let's get back to our opening inventory. So it says our opening inventory is 800 units. So we say 800 units times 30, okay? And that is 24,000 for our opening inventory. Okay, and then closing inventory, we calculated that it is 1,300 units, but now we need the cost. So it's going to be 1,300 units times 30, and it's going to give me, so 1,300 units times 30, because that is now the absorption cost, and then we get 39,000. So that's the value of our closing inventory. So it's really important to start off by calculating your absorption cost, because we will need it to calculate our other items. So our closing inventory here, I'm supposed to add less closing inventory. Is 39,000. Okay, so this is just a difference. So absorption costing, you always have to include your fixed costs. That's why, to make it easier for you, we have to calculate our absorption cost per unit, and then your fixed manufacturing overheads will always be given to you in a large sum. So we have to divide it by our units produced so we can get that unit for just one item. Then when we add it all up, we get our cost per unit, and it will be much more easier to move forward. So that's the difference between absorption costing and marginal costing, is the treatment of our fixed manufacturing overheads, only manufacturing overheads. All right, okay, so let's move on. So now that we have our opening inventory, production cost, and our less closing inventory, so in your normal statement you will have add purchases, but this is not a normal business. It's a manufacturing business. Okay, we are making the goods ourselves. That's why we are we are having production cost because we produce it ourselves. So we will say 24,000 opening inventory, add our production cost, which is 150, minus our closing inventory. We should be getting 135,000 for our gross profit. So this is 135. Okay. No, that's actually our cost of sales. Our cost of sales is 135,000. Okay, less cost of sales. Then our gross profit will be 180 minus 135,000, which we get is 45,000 as our gross profit. Okay, now that we did all of that, we need to calculate our net profit, and how we do that is we have to less non-manufacturing or non-production overheads. Okay, so this is your variable, selling and admin, and then it's your fixed, selling and admin. So there's a difference. Okay, so you have two types of variable cost and fixed cost, those that are non-manufacturing overheads and manufacturing overheads. So the ones that we calculate inside your absorption costs are only those that are part of manufacturing overheads. Do not include your non-manufacturing overheads when calculating your absorption cost per unit, or part of your, or calculating your production cost. So our variable selling, so it tells us that it's $3. All right, so remember here we sold, its selling cost per unit. So how much cost we incurred for selling something. So we sold 4,500 goods. So of those 4,500 goods, each of them cost us $3. Okay, each of those sales we made cost us $3. So we say 4,500 times $3, and then we get your 13,500. And then we have your fixed selling and admin expense, which is just straight up like that, so you can just say your 20,000. And then what is your total non-manufacturing overheads is your 13,500 plus your 20,000, which gives us 33,500. So we should get our net profit next, and our net profit will be our gross profit less your non-manufacturing overheads, which is 45,000 minus your 33,500, and this is 11,500. I hope this all made sense, and please watch the next video where we will go over our variable costing, also known as your marginal costing. Thank you for watching, and subscribe for more videos. Bye.